Today, markets whipsawed by events, dear boy, events. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. This is our weekly market update where we start in the US, cross to Europe and Asia, and then in Australia, covering commodities and crypto along the way. When UK Prime Minister Harold Macmillan was asked what was the greatest challenge for a statesman, he replied, "Events, dear boy, events." This is hardly relevant to this week's market review because they were whipsawed through the trading day, asking what is a negotiating gambit and what is a serious policy proposal. After opening higher, they sank mid-session during a public berating of Ukrainian President Zelensky by President Trump and Vice President Vance at the White House. Zelensky is not ready for peace if America is involved, Trump said in a post on Truth Social afterwards. But US investors shook off the volatility through mid-afternoon and then pushed still higher leading into the closing bell, so that all three US benchmarks rallied, with financials leading all 11 of the S&P 500 industry sectors higher. As a result, the S&P 500 climbed 1.59%, the NASDAQ gained 1.63%, while the Dow Jones Industrial Average rose 1.39%. The Volatility Index was down 7.1% to 1963. Across the week, the Dow was up 0.95%, the S&P 500 down 0.98%, and the NASDAQ was down 3.47%. Both Nvidia and Tesla rallied to finish the week, rising 4% and 3.9% respectively, but were still down 7% and 13% for the week. Shares of Nvidia, which reported earnings late on Wednesday, swung to losses as investors focus on signs of increasing AI spending in the industry. And shares of the Elon Musk-led electric vehicle company were down about 40% from their late 2024 highs, a reversal that accelerated in recent days after data showed that Tesla's European car sales nearly halved in January. This week's roughly 17% decline in the share's price suggests the slowdown in Tesla's mainstay auto business is starting to unnerve traders. That's bad news for a stock whose fortunes have been driven by investor enthusiasm as much as fundamentals. The MSCI Global Index was up 0.66% on Friday, but still down 1.33% for the week, while the Stoxx 600 European Index was up another 0.6% across the week after touching a record high on Wednesday. But Australia's ASX 200 rounded off earnings season on a negative note, slipping 1.2% to post its second consecutive month of losses, tumbling 4.2% in February and wiping out all the gains made this year so far. In the US, data show that the so-called Core Personal Consumption Expenditures Index, that's the Fed's preferred inflation metric, which excludes food and energy, rose 0.3% in January from the previous month. It has risen 0.2% in December. The 12-month PCE was 2.5% from 2.6% in December, while the core PCE measure fell to 2.6% from an upwardly revised 2.9%. The central bank targets an inflation rate of 2%, of course, so inflation remains sticky as the US upgraded its estimates of annualized core inflation in the fourth quarter from 2.5% to 2.7%, which is materially above the Federal Reserve's target of 2%. And all of this is before the impact of Trump tariffs and the mass deportation of America's largest source of cheap labor, namely illegal immigration. The January personal spending report, released at the same time, showed that inflation-adjusted consumer spending fell 0.5%. That's a red flag for growth and dampened some risk-taking, and jobless claims stood at 242,000, higher than the estimates of 221,000. US Treasury yields fell to a new multi-month low. The 2-year was at 3.987, while the 10-year was at 4.21%. Traders have raised bets on Federal Reserve interest rate cuts, now seeing 2 quarter-point reductions this year, with the first likely in July. Investors increased their holdings in US equity funds over the week to February 26th, buoyed by confidence in the economy's resilience and expectations of that federal rate cut. The US large cap funds experienced $20 billion in net purchases. That's the highest in 2 months, with multi-cap funds attracting $137 million. However, small cap and mid-cap funds saw outflows of $545 and $197 million, respectively. Global hedge funds sold more stocks than they bought by the largest amount in a year, driven mainly by their bets that stocks will indeed drop further, according to Goldman Sachs. And they said that the gloomy sentiment was spreading across all geographic regions, but mainly in North America and parts of Asia, and was seen in almost all company sectors except for communication services. Exposure to the Magnificent Seven group of US tech and growth stocks is now at the lowest level since April 2023, indicating hedge funds' de-risking episode could be in the final stage. Well, we'll see about that. Trump is set to impose tariffs on China, Canada, and Mexico, and has indicated that European exports are next in line. The threat of escalating tariffs has boosted the dollar, but has also stoked worries about the impact of widespread duties on the US economy. But Trump created some confusion over the looming duties on top trading partners, Canada and Mexico, on Wednesday by signaling they would take effect on April the 2nd, which would be another month-long extension. But a White House official later said the previous March 4th deadline for the levies remains in effect, as at this moment, stirring further uncertainties about US trade policy. And Trump also floated a 25% reciprocal tariff on European cars and other goods. The greenback, which has been under pressure in recent weeks, rose, with the dollar index, which measures the greenback against a basket of currencies, including the yen and the euro, was up 0.9% across the week. The euro fell by as much as 0.37% to a 2-week low of 1.036 before paring some of the decline to trade at 1.0375. Gold's US futures settled 1.6% lower on Friday and is down about 3% across the week. It was last at $2,862 an ounce, but many argue the bullish trend is still in place. On Tuesday, Trump initiated an investigation into potential copper import tariffs, aiming to revitalize domestic production of this crucial metal for various sectors. New trade tariffs are recognized as inflationary and may precipitate global economic instability. Thus, safe haven flows into precious metals increased over the past month, which explains the current gold story. And it's risen uninterrupted for most of 2025. And in addition, of course, central banks remain key bullion buyers as they aim to diversify their reserves amid the changing geopolitical landscape. Central bank behavior will be key for gold's fortunes, as they have been an important element for demand in recent years. Oil prices fell on worries stoked by the White House meetings, tariffs, and Iraq's decision to resume exports from the Kurdistan region. Crude oil WTI futures made a run for a 10-day moving average, but failed to complete the breakout, keeping us locked in the trading range. Oil prices were hesitant to move higher and to break out because of the mixed signals like the OPEC Plus hesitation, as well as a reminder from President Trump that he will not hesitate to reinforce scheduled tariffs unless something dramatic happens. The latest events concerning Ukraine will impact prices ahead as supply concerns resurfaced. Trump actually revoked Chevron's license to operate in Venezuela. Brent crude futures settled at $70.58 a barrel, down 1.16%, and US West Texas Intermediate crude finished at $69.76 a barrel, losing 0.84%. In Europe, shares were lower on Friday thanks to pessimistic outlooks regarding the US tariffs on the EU. Germany's DAX closed higher there across the week, along with the London FTSE, although the CAC 40 in France was lower, with automakers and component makers' shares under pressure from those tariff risks. Economic activity remained weak in the euro area. Real GDP growth was just 0.1% in the fourth quarter of 2024, missing the ECB's estimate of 0.2%. The high-frequency indicators signal continued sluggishness, although Barclays does not foresee an imminent recession, and the inflation outlook remains largely stable, they said. Barclays expects the ECB to revise headline inflation slightly higher for 2025 at 2.2%, but then keep projections for 2026 unchanged at 1.9%. And Barclays expects the ECB to move forward with a 25 basis point cut at its March meeting, citing a deteriorating growth outlook and limited inflationary risk. The adjustment would bring the deposit rate to 2.5%, as the Governing Council is likely to conclude that the updated macro outlook necessitates a further easing of the level of policy restrictions, they said. While the ECB has previously maintained that policy remains restrictive, Barclays believes the language will soften, reflecting the gradual shift towards a more accommodative stance. The central bank is likely to remain non-committal on the future policy moves, though, and keep April live for another possible cut. Asian stocks tumbled on Friday, with Japan and South Korean stocks leading the declines as local tech shares sank following the Nvidia sell-off on Wall Street. While investors analysed Tokyo's latest inflation data, Tokyo's core consumer prices rose by 2.2% year-on-year in February. That's a deacceleration from January's 2.5%, according to data on Friday. Despite the moderation, the inflation rate does remain above the Bank of Japan's 2% target for the fourth consecutive month. Other data show that Japan's industrial production in January decreased by 1.1% month over month, aligning with market expectations. Manufacturers anticipate a 5% increase in output for February, then followed by a 2% decline in March, indicating cautious optimism about future production levels. And currently, retail sales experienced a 3.9% year-on-year rise in January, in line with projections reflecting steady private spending. Japan's Nikkei 225 plunged 3.2% to its lowest level since the middle of September 24, and the Topix was also down, as SoftBank shares tumbled 5.3%, Tokyo Electron shares slid 5.1%, Panasonic fell 2%, and Advantest shed 0.6%. South Korea's Kospi declined 3.1%, with tech heavyweights Samsung Electronics and SK Hynix dropping 2.2% and 4.7% respectively. China's Shanghai Composite fell more than 1% on Friday, while the Shenzhen CSI 300 index lost 0.9%. China's banks are cutting the interest rates offered on US dollar deposits after being asked to do so by the central bank, possibly to curtail dollar hoarding and also to prop up weakening yuan. Mainland retail investors and exporters have built up nearly $1 trillion worth of deposits because of higher US yields and the yuan slide. Banks across China, big and small, have over the past few weeks been told by the People's Bank of China they have to cut dollar deposit rates. This guidance seems aimed at discouraging a further rise in dollar deposits and spurring more conversion of those dollars into yuan. Regulators seem worried about the proportion of cash being held onshore in dollars. Some banks have already announced rate cuts, and China's capital controls and propensity among citizens to keep savings in dollars have meant onshore dollar deposits fetching less than in international markets, where 3-month dollar deposit rates are currently about 4.5%. But they're still higher than returns on the domestic currency, with the yuan 3-month deposit rate around 1% or lower. Foreign exchange deposits grew to $892 billion last month. That's the highest level since April 2023. Households' foreign exchange deposits stood at about $146 billion, up 18% from a year earlier, and corporate deposits grew to $451 billion. That's according to PBOC data. China's commercial banks sold the most foreign exchange to their clients last month since July, according to official data showing rising demand for foreign currency. The conversion ratio, a gauge that measures households and corporates' willingness to sell dollars for yuan, fell to the lowest level in 7 months. The wide gap between high US interest rates and falling Chinese yields have been a factor eroding the yuan's appeal with onshore investors. That yield gap hit its widest ever level in January. And equally, US President Donald Trump's tariff threats and a wobbly domestic economy have weighed, causing the yuan to weaken. It's lost 2.2% against the dollar since Trump's election win in November. The PBOC has previously, in 2023, asked only the country's big 5 state banks to cut dollar deposit rates, capping them at 2.8%. It's not clear if the big 5 have been asked to cut dollar deposit rates again this time. Hong Kong's Hang Seng Index dropped 2.6% on Friday, but in February, Hong Kong experienced remarkable gains, primarily driven by investor enthusiasm surrounding DeepSeek's advancement in AI. It was up almost 50% year to date. Hong Kong-listed Alibaba stock surged nearly 48% in February, while Xiaomi shares have climbed by more than 37% this month. Indian stocks were lower at the close. The Nifty 50 fell 1.88% to hit a new 6-month low. In Australia, the share market erased its year-to-date gains on Friday as fears that higher tariffs on US imports from China could hit demand for Australian commodities pushed the exchange lower, and technology stocks were sold off. The ASX 200 rounded off earnings season with a negative note, slipping 1.2% to 8,172.4, and the All Ords fell 1.2%. 10 of the 11 indices sectors were down, with the technology and material sectors leading losses. Australia's major miners suffered amid concerns that the tariffs on Chinese steel could hit iron ore demand. BHP shed 2.5% to $39.04. Rio Tinto was 2.9% lower to $113.70, and Fortescue fell 3.7% to $16.51. Elsewhere, ASX technology stocks extended losses, selling off after chip-making giant Nvidia's 8.5% fall in US trading. The sector was 2.9% lower. Logistics giant WiseTech hit its lowest level in 7 months, tumbling 4.8% to $89.50. In corporate news, Star Entertainment's board has said it isn't sure if it can continue to trade beyond Friday, saying a range of conditions needed to be met on Friday for the company to remain operational. The casino operator slumped 15.4% to 11 cents. Endeavour Group slumped 7.2% to $4.17 after its interim profit fell 15.1%, driving the retailer and hotel operator to lower its dividend to 12.5 cents. Harvey Norman lifted 2.6% to $5.22 after half-year sales revenue hit $4.8 billion, boosted by higher revenues from franchises across its portfolio and a slew of international store openings. TPG Telecom lifted 7.2% to $23.30 after reporting a 3.4% rise in underlying earnings to $2 billion. The country's third largest telco said the number of mobile customers had risen quickly owing to a new network sharing arrangement with Optus. Market darling Life 360 advanced 7.2% to $23.30 after beating its earnings guidance. It is approaching 80 million global users for its popular family tracking app. And Vista Group rallied 16.4% to $3.40 after earnings soared in 2024 as the data analytics provider reported a jump in clients transitioning to its cloud solutions. And John's Lion Group dived 10.3% after the company went ex-dividend on Friday. Now, as Christopher Joy notes, Australia avoided a recession during the global financial crisis and was quickly bailed out of the pandemic by unprecedented government handouts, near zero rates, massive money printing, and the mother of all public investment programs. Since the early 1990s, Australia has always seemed to win the economic lottery. Yet, we've arrived today with parlous productivity, high living costs, and a government sector that accounts for the highest share of the economy since World War II, aside from a temporary spike during the pandemic. Total government spending as a share of GDP is at its loftiest level since 1958, which is as far as our records go back. This includes all levels of government. And he says, it's like we've suddenly jumped back in time to the period before the deregulatory reforms and the advent of the idea that private enterprise should be the principal driver of progress. In the post-GFC world, governments try to pour cash on all problems, with enormous amounts of pork barreling already being unveiled. Ahead of the election, this direction of travel is unlikely to change anytime soon. And it's now showing up in the federal government budget, which, on our numbers, he said, lurched into a deficit late last year. Smoothing out the volatility in the data, we estimate that the federal budget deficit has grown to $2 billion a month, or $24 billion annually. Absent a cathartic economic crisis, there is no collective appetite in Australia for engaging in fundamental reform, he concluded. Well, perhaps this is one reason why the Aussie slid to 62.02 cents against the US dollar and to 49.35 pence against the UK pound. And talking of falls, Bitcoin has fallen firmly into the sub $100,000 US level. It was last at 85,410. I discussed this in my recent show, which shows that the bears are in charge. Indeed, Jeff Kendrick, global head of digital assets research at Standard Chartered, cautioned against buying the dip just yet. In the note to clients, stay patient, he said. These types of losses rarely end well, and I still think the big capitulation is yet to come. And amusingly, we should also note that Bybit, the world's second largest cryptocurrency exchange by trading volume, claiming to serve a global community of over 60 million users, suffered a significant hack recently, but despite this, Bybit said trading activity remains strong, with volumes exceeding 40 billion in the past 2 days, and they announced significant progress in restoring assets and rebuilding trust following that recent security incident. Bybit, they said, has now swiftly implemented recovery measures and enhanced security protocols to protect its global user community, and has successfully restored, wait for it, 77% of its assets under management to pre-incident levels, underscoring, they say, its robust recovery strategy and sustained client confidence. But I ask, what about the rest? We'll see. Anyway, standing back, the level of uncertainty across markets is reaching fever pitch, and we can expect to see even more volatility as the world order is shifting under our feet. In fact, on Tuesday, I'll be discussing the implications for investors with Damien Claston from Nucleus Wealth on my live show. That is one not to miss. But going back to where I came in, it's all about events, dear boy. Events. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.